Mainstream lenders are institutions like banks, credit unions, auto manufacturer financing, credit card issuers, and merchant credit cards. They offer traditional loan products and rely heavily on each borrower's credit report and credit score when deciding whether to approve a loan. Alternative lenders are organizations like check cashers, payday lenders, title loans, pawn shops, and seller financed used car loans. So they typically don't rely on an individual's credit report when making a loan decision, which makes it easier for borrowers with a poor credit history to receive financing. These firms focus on making loans that are collateralized either with an asset or access to a borrower's bank account. In this way, if a borrower makes a late payment or fails to pay, the lender can seize the borrower's assets and enforce payment through other legal means. According to FDIC data, approximately 34 million U.S. households, or about 25% of the population, are unbanked or underbanked, meaning that they have no or only a limited relationship with a bank or credit union. To gain access to loans and other financial services, the unbanked and underbanked often use services provided by firms operating in this alternative financial service system. Payday loans are short-term loans designed to be repaid within a few weeks when the borrower receives a paycheck. The APR of a typical payday loan is over 300%. The annual percentage rate, or APR, on a payday or alternative loan is based on the fees rather than a stated interest rate. So in the case of a borrower who obtains a 2-week loan for $500 with a $75 loan fee, the APR would be 391%. If no other fees are charged and that borrower pays off the loan on time. So the way we would calculate this is, first, we calculate that $75 is 15% of $500. If this rate were charged every 14 days, that means it would be charged 26 times in 1 year. 26 times of the 15% charge is 391% for the year. Pawn shops and title loan companies base their loan on the value of collateral, which would be something you give the lender that they can sell if you don't repay the loan in a timely manner. So for example, if you pawn a $1,000 diamond ring, you might receive a 3-month $400 loan. At the end of the loan period, you could owe the pawn shop anywhere from $450 to $500 to get the ring back. Pawn shops typically provide a longer period to pay back a loan, but they give less of a loan compared to the value of the collateral. Alternative financial service providers seek to provide a high level of social interaction and inclusion for their clients, making customers feel more welcome compared to mainstream institutions. In addition, alternative lenders are quick to point out that fees such as overdraft charges on checking accounts, late fees on credit card payments, and overdraft expenses on debit and ATM cards may be higher at a bank than what it costs to borrow a similar amount of money from a payday lender. In general, however, the best approach is to rely on low-cost borrowing options from mainstream financial service providers, if possible. So how do you do that? How do you avoid these expensive loans? Well, first you need to have an emergency fund, and then consider other sources of funds. For example, you could withdraw the funds from your savings, investments, or other financial accounts if you have them. You could borrow money from family or friends. You could obtain a loan from a bank, credit union, or other mainstream financial institution, or you could just work more hours and increase your pay. You could even sell something of value And then lastly, you could use alternative financial services, those payday lenders and pawn shops that we just talked about.